Good morning, everyone. We are now looking at Rsk4804. And for Rsk4804, we'll start with housekeeping. Please note that I'm going to be resharing the orientation video on the different WhatsApp groups as well. So I'm also going to make sure that I reshare the orientation video on the different WhatsApp groups so that on the orientation video, it shows you guidelines on exactly how to access our website and how to access the material on our website as well. For RSK4804, there are going to be 3 books that you're going to be utilizing. The one by C.B. Joseph, the one by Bandyopadhyay, and the other one by Whitney as well. So those are the 3 textbooks that you're going to be using. So you will see that for every learning unit that you're going to be doing, please note that you have to study according to the study guide. Because for every learning unit that you're going to be doing, in some learning units, you're going to be using a particular book. And in some learning units, you're going to be using even all 3 books as well. Like what you see in study unit 1, you'll see that study unit 1, it asks you to go through all the 3 books that are recommended for the curriculum. So please note that once we create a user account for you on our website, you are able to access the soft copies of these textbooks. Even if you're on the trial package where you are saying that you haven't yet registered as well, if you create a user account on our website and you indicate to me what your email address is and which modules you want to be linked for, I will be able to link you on the trial package before you register until end of March as well. So that until end of March, when we conduct these classes, because remember, we're going to be having a class today, and then we're having another class on the 28th as well. And for all these classes, it's very beneficial for you to attend these classes having the soft copies of the textbook. Even if you're on the trial package, we do give you access to these textbooks because we don't sell these textbooks. We make them available to you at no cost as well. Now, so once you create a user account on our website, once you create a user account on our website, you are able to just send me your email and the modules that you want to be linked for trial. Then I'll also link you to those modules so that you're able to benefit as well. Now, in the orientation video that I'm going to send you, it's a YouTube video, and in the orientation video, it gives you guidelines on exactly how to access the material on our website, which is the soft copies of the textbook, the videos going to the study units, as well as the revision material. It shows you exactly how to access that material. Then over and above that as well, the orientation video gives you a rundown of exactly what to expect when it comes to your curriculum. So it's very, very beneficial for you to understand exactly where are you coming from and where are you going when it comes to your curriculum, because you see that your curriculum, there is going to be 4 topics, and in those 4 topics, there's going to be 12 study units that you need to cover. And for each study unit, some study units is just 1 textbook that you need to go through for a chapter. And in some study units, they will tell you exactly which sections in the textbooks that you need to also make sure that you cover as well. So please, most importantly, as you go through this curriculum, make sure that you go through it hand in hand with the study guide, because the study guide is the one that's going to show you exactly for this learning unit, what do you need to go through. So please make sure that you take note of that. So it's very, very important that you also go through the orientation video so that you know exactly what to expect when it comes to this particular module. Because today's class, we're going to jump straight in by looking at study unit 1. So we're jumping straight in by looking at study unit 1. Now, when it comes to a quick rundown of exactly what we're going to be covering for Rsk4804, you will see that Rsk4804 in its nature, it's a mixture of calculation. When you now look at the exam, it's a mixture of calculation and theory. So it's a mixture of calculation and theory. So which means that you should make sure that you master not just calculation, but also theory as well. So when it comes to the module purpose, according to the lecturer for Rsk4804 says that when it comes to the module purpose, this lecturer says the purpose of this module is to equip you with a thorough and comprehensive knowledge of credit risk in a way that would stimulate an interest in credit risk analysis and management. This module will be helpful to both borrowers and lenders, especially in understanding the relevant theories and concepts, as well as the application of such knowledge in the credit risk management setting. You will also understand the complexities that led to the 2008 global credit crisis that shook the financial world, and appropriate measures which are now in place to prevent a repetition of the phenomenon and mitigate any additional risk. And we're going to look at this as well when it comes to the evolution of the Basel Accords as well. Then they also say, knowledge of this module will give you a better understanding of how to deal with most financial products in the market, which embed credit risk. So as you can see, by the name of the module, we are going to be looking at what? Credit risk management. So here they say, finally, you should be able to evaluate through case studies and other examples the practical application of credit risk management theory to enhance and any risk prevention and related mitigation strategies in the context of your organization. So in this module, the following topics will be covered: credit risk analysis and management, firm or obligor credit risk, credit portfolio risks and mitigants, credit risk when you look at project and working capital, the last line of defense, which is security, which is going to be the last section there. Then they also tell us exactly what the prescribed textbooks are. And the one by C.P. Joseph, the one by Bandyopadhyay, and the other one by Whitney as well. Then when it comes to the module outline, as you can see, topic 1, you are going to be looking at learning unit 1, which looks at credit risk and analysis and management. Then topic 2, you are going to be looking at learning unit 2, 3, 4, 5, and 6. And then topic 3, you are going to be looking at unit 7, 8, and 9. And then topic 4, you are going to be looking at learning unit 10 and 11. And then topic 5, you're going to be looking at what? Learning unit 12 as well. So please take note of the rundown of exactly what we should expect when it comes to this to come to the curriculum as well. Now, when it comes to learning unit 1 introduces us to credit risk analysis and management. And here the lecturer says, when it comes to the purpose of this learning unit, the lecturer says, to understand the credit risk in its entirety, including processes, credit risk management framework, credit risk analysis, and challenges therefore as well. And then they say, for this learning unit, we need to look at chapter 1 of Bandyopadhyay, chapter 2 of Whitney, and chapter 2 of C.P. Joseph. So which means for learning unit 1, there are 3 chapters from 3 different textbooks that we need to make sure that we go through. Now, under overview of the unit, they say, the lecturer says here, under overview of the unit, the lecturer says, credit risk is the potential that a borrower or a group of borrowers will fail to meet their contractual obligations and the future loss associated with that. Furthermore, it might involve investments deteriorating in quality or going through default with consequent loss to the bank. It is therefore crucial that people with relevant or necessary skills and techniques be employed to enable proper assessment of credit risk. A firm must put in place a quality credit risk analysis structure to ensure a clear understanding of the real risk involved when extending credit, which then should be priced appropriately. So which means when we go through this particular module, please note that the main thing that you're going to be looking at there, you are going to be analyzing credit risk from a supplier of a credit perspective. So you're going to be analyzing credit risk from the supplier of credit. Remember, the supplier of credit is the lender, right? So you're looking at credit risk from the lender's perspective. So that's what you need to make sure that you keep in mind as well. So under introduction, they say you have to work through chapter 1 of prescribed book, Bandyopadhyay, with special attention to credit risk drivers, borrower's level risk versus portfolio risk, management of credit risk in banks, role of capital in banks, the difference between regulatory capital and economic capital, credit risk management framework, up to page 13, and factors affecting credit risk. So any additional information relating to the topics must be sourced individually to add to your knowledge. So which means when we go through this, we need to make sure that we go through up to page 13. So in general, what you need to take note of, previously, when it comes to this module, previously, we were utilizing CB Joseph to go through the module. But the rule is that after a certain number of years, they are obligated to refresh the curriculum. Now, as they refreshed this curriculum, please note that they also included Whitney and Bandyopadhyay as well. And because of this, take note of the general trend. Whenever they refer to a chapter in CB Joseph, normally you go through the whole chapter. But whenever they refer to Bandyopadhyay and Whitney, please take note of the page ranges or the sections that you are specifically asked to cover. Very, very important. Because usually from Bandyopadhyay or Whitney, the lecturer is trying to skim out only the relevant information to the curriculum. And because of this, you will see that whenever they make reference to Bandyopadhyay or Whitney, usually they are going to ask you to go through certain sections. So please make sure that you take note of that. So here in Bandyopadhyay, we need to cover everything up to page 13. So this is what they are asking us to take note of. And under self-test, when we go through this section, we should be able to answer the following questions when we go through this section. What do you understand by credit risk? And we should also be able to answer the question, explain why credit is considered a powerful driver in the economy. Because typically, going into the exam or the assignments, the concepts or the questions that the lecturer picks from, they are based on the self-test questions. So the question that the lecturer is going to end up asking you in the curriculum, in the assignments, or asking you in the exam, they are based on what is expected for you to answer when it comes to the self-test. So which means your self-test questions there, we use them as a guideline on exactly what are you expected to cover when it comes to material in the textbooks. So is there any question so far before we move on to the chapter from Bandyopadhyay, chapter 1 of Bandyopadhyay? Are there any questions? So looking at chapter 1 of Bandyopadhyay, chapter 1 looks at introduction to credit risk. And here, the author says, credit risk is the potential that a borrower, that a bank borrower or a group of borrowers will fail to meet its contractual obligations and the future loss associated with that. So when you talk about future contractual obligations, these are typically failure to pay interest when it falls due, and failure to repay the principal amount when it falls due. So the failure to meet one of the two is typically what triggers what? Credit risk. So for most banks, loans are the largest and most obvious source of credit risk. However, other sources of credit risk exist throughout the activities of a bank, including the banking book and trading book, and both on and off the balance sheet. Banks are also increasingly facing credit risk in various financial instruments other than loans, including bankers' acceptance, interbank transactions, trade financing, foreign exchange transactions, financial futures, swaps, bonds, equities, and options, in the extension of commitments and guarantees, and the settlement of transactions. Since the exposure to credit risk continues to be the leading source of problems in banks worldwide, banks and their supervisors should be able to draw useful lessons from the experiences. Banks should now have a keen awareness of the need to identify, measure, monitor, and control credit risk, as well as to determine that they hold adequate capital against these risks and that they are adequately compensated for risks incurred. So which means in this case, they are saying credit risk also emanates from the instruments that the banks trades as well. And we're going to look at that in a lot more detail when we analyze the evolution of the Basel Accords. Because when we analyze the evolution of the Basel Accords, that's where we're going to look at this in a lot more detail as well. Now, as you can see, what the lecture is trying to emphasize there is that when we look at the credit risk of an organization, so when you look at the credit risk of an organization, we are saying for a typical bank, the accounting equation for the bank is your assets is equal to equity plus liabilities. And typically, the liabilities is what we refer to as the debt. So it's basically debt financing. And the debt financing for a bank usually emanates from two sources. Money that is being deposited by the bank into the bank by depositors, and any other source of debt where the bank would have borrowed money from other different sources as well. And now, how else does the bank finance itself? The bank finances itself through ordinary share capital. So it also finances itself through ordinary share capital. And in short, we're just going to refer to this as capital of the bank. So in short, we're going to refer to this as the capital of the bank. So why does the bank need financing? The bank needs financing for it to be able to generate a return, to invest in the assets of the bank so that they generate a return. So with the sole aim of generating a return from the assets of the bank. So what are these assets that the bank is invested in? And typically, the assets that the bank invest in, these assets typically would be loans. Remember, to generate a return for the bank can give out loans to its customers, whether it's a short-term loan, a long-term loan, or even through mortgages as well. Where, for example, if they're going to be financing your house, or they're going to be financing, for example, your vehicle financing as well. So these are the typical loans that the banks also gives out to generate the return. Because remember, the return from these loans is the interest that they earn, isn't it, right? Then they also invest in different types of securities. So they also invest in different types of securities. Now, in doing all this, why are we worried about the capital of the bank? We are worried about the capital of the bank because in all these activities to generate a return for the bank, there is also a risk that the bank might suffer a loss. And if the bank suffers a loss, the question now becomes, does it have enough capital to absorb these losses? Because if the bank does not have enough capital to absorb these losses, it means the bank is not able to continue as a going concern. So which means when we look at credit risk here, remember we said credit risk is the risk that the parties that the bank would have borrowed from the bank might end up defaulting. And if they default on their obligation, there's a risk that the bank will suffer losses. Now the question becomes, so why are we interested in analyzing credit risk? We need to make sure that there is enough capital available to mitigate these credit risks that can materialize. Are we on the same page? Any questions? Anyone lost? So in the next paragraph, they go on to say, remember I said to access the material that we are going through now, right? The study guide and the guidelines on exactly what to expect during when it comes to the curriculum, you get it from my UNISA because the lecturer does share that. When it comes to the soft copies of the textbook, that's why I'm saying when it comes to the soft copies of the textbook, if you create a user account on our website and then you ask us to link you, even if you have not yet registered, we can also link you under the trial package. And under the trial package, you are able to get the soft copies of the textbook because we don't sell these textbooks. So you are able to access the soft copies of these textbooks, which are already highlighted with a bit of notes on them. You are also able to access a limited number of videos so that during this period that we're going to be going through these free classes as well, you will be able to access a limited number of videos to prepare for the coming class. Because remember, our next class from today is the class on the 28th. And in the class on the 28th, we are going to be continuing with Learning Unit 1. And as we continue with Learning Unit 1, it's beneficial for you to have the soft copies of the textbook with you. It's beneficial for you to have gone through the video from last year so that if there's something that you don't understand, you are able to participate and ask questions and have your issues ironed out as well. That way, you benefit better. So even if you're not yet registered, you are able to access that material as well. I see there's a raised hand.
Afternoon, colleagues. Thank you so much for acknowledging my hand. Just in relation to the question from Gele, because I also wanted to find out, but I remember from your introduction, you said that we will get YouTube video. If it's possible, please, can we perhaps maybe after the session or maybe a platform where we can provide our names for people that need to be linked? Because I understand that you're saying we need to be linked to get the soft copy books. So then how would you know, who must we email rather, so that we can be able to be linked? Thank you, Bud.
Were you communicating with me via WhatsApp?
Yes, yes.
Yeah, just send me a
Yes.
WhatsApp message. So just send me a WhatsApp
Oh, okay. You're the
message.
gentleman I was talking to. Thank you.
Yeah, just send me a WhatsApp message and I'll send you the links so that you're able to be linked as well. Also, I would recommend that you also, I'm going to follow up with all the students as well who are not yet registered, so that there's a WhatsApp group that is available for those who are on the trial package as well, so that it's easy for me to communicate. When I communicate with you, I just send you that information on the WhatsApp group, so that on the WhatsApp group, you'll be able to access all that material without having to worry about who have I sent to, who have I not sent to as well. If you join that WhatsApp group for the trial package as well, for the trial students, you will be able to, it's easy, but I'll make sure that I follow up on that after the classes after 5 today. All right. Are there any other questions? All right. So here they say, on the second paragraph, they go on to say, so please note that when we look at credit risk management, mainly, if you look at the way this book is structured, remember we said we are looking at it from the perspective of the lender, and usually the lender is the financial institution. So which means unless otherwise stated, your mindset should be looking at it from a credit risk management of a lender, which is the financial institution as well, unless otherwise they state otherwise as well. So here they say, by definition, credit risk is the risk resulting from uncertainty in the counterparty's ability or willingness to meet its contractual obligations. Credit risk relates to the possibility that the loans will not be paid, or that the investments will deteriorate in quality or go into default, with consequent loss to the bank. Then they also look at major drivers of credit risk. And I remember the lecturer asking questions to do with major drivers of credit risk. If it wasn't the Jan-Feb 2026 paper, it was one of the 2025 papers as well. I remember there was a question to do with the drivers of what? Credit risk. So here they say, credit risk arises because in extending credit, banks have to make judgments about a borrower's creditworthiness, its ability to pay principal and interest when due. So this creditworthiness may decline over time due to change in its financials, poor management by the borrower, or changes in the business cycle, such as rising inflation, recession, weaker exchange rates, and increased combination. So these can also end up affecting the creditworthiness of the borrower as well. So here they say major drivers of credit risk are. So if ever they ask you for the major drivers of credit risk, here they say major drivers of credit risk are, the first one being default risk. And here they say default risk is where the obligor fails to service debt obligations due to borrower or specific or market specific factor. So where the obligor fails to service debt obligation. And remember we said the debt obligation can either be the payment of interest or it can be the payment of what? The principal amount as well. Then there is also recovery risk. And then they say recovery post-default is uncertain as the value of the collateral changes unexpectedly. So which means we are saying here, when default happens, there is going to be, we are expecting two outcomes when default happens. So when default happens, we're expecting two outcomes. It's either there is going to be a loss given default, so that if the default happens, how much are we going to lose out from the principal amount from the money that was still being owed by the customer? How much are we going to lose out? Or how much are we going to be able to recover as well? So which means in the case where there is collateral, how much of this collateral are we going to be able to recover? So which means from, let's say for example, if our customer is owing us 10 million, we are going to say of the 10 million now that we say, okay, the customer is not able to repay us our money, right? Currently, the customer is owing us 10 million. The question that is going to be asked is, how much collateral did we put against this loan that we gave the customer? Maybe they are going to say, or maybe the customer put in a collateral of a house, and then we are going to say, this house that has been put in as collateral, it's going to contribute towards what? The recovery. Recovery, what we're being owed, isn't it, right? Now, this house as well, the question becomes, what is the current value of this house? If you sell this house today, how much are we going to be able to recover? Let's say, for example, if we're going to recover, let's say the house that has been put in as collateral is worth 4 million. It means our recovery rate is going to be 4 million of the 10 million, which is 40% of the debt. So it means if we're able to recover, for example, 4 million of the 10 million, which is 40% of the debt, it also means the 6 million is what we're going to end up losing out from the money that we're being owed. And the 6 million becomes what? The lost given default. So which means you should be in a position where you are able to distinguish between say, every time there's going to be a default, there's going to be two things that are going to happen. They are mutually exclusive, which means it can be either or. It's either we recover some of the money or we end up losing some of the money as well. Are we on the same page? All right. On the next section, they also talk about spread risk. And here they say, credit quality of obligor changes leading to fall in the market value of the loan. Now, when you talk about spread risk, they are basically saying that how much is the credit quality of the obligor compared to the risk-free rate? Because remember, as an investor, you have an option to invest in a risky asset or to invest in a risk-free asset. A typical risk-free asset is where you're going to be investing in treasury bills. Like, for example, where if the government issues treasury bills, which is T-bills, usually they mature after 90 or 91 days, which means if the government issues these treasury bills, we know that there are different ways that the government can actually utilize to actually recover their money. It's either they can print more money or they can what? Increase taxes so that they're able to cover their debt. And because of this, generally, the loans or if you invest in any securities that has been issued by the governments, usually they are considered what? To be risk-free securities. Now, when you're talking about the spread risk, we know that, for example, we know that when you are charging your interest rate, we know that your nominal rate is given as the real rate plus inflation premium plus the risk premium. And we also know that the real rate plus inflation premium is what we refer to as the risk-free rate. So is what we refer to as the risk-free rate. So which means, remember we said, if you are going to be investing in any securities that are issued by the government, because there are different ways that the government can raise that government can come about to pay you back the money that they are owing you. It's either they raise taxes or they what? Or they print money as well. It means that the interest rate on treasury bills is going to be the risk-free rate, right? Now, over and above this as well, we are saying that when you are now look at other instruments which are not government securities, there is going to be a risk premium that is going to be charged. So when you talk about the spread risk there, we are looking at this other risk premium that you need to charge over and above the risk-free rate when you are giving out loans. So which means when the spread risk is high, it means that there's more risk premium that you have to take into account when you're charging a customer, right? So when the spread risk is high, it means there's a higher risk premium that you have to take into account. And if the spread risk is low, it means there's a lower risk premium that you have to take into account. So which means if the credit quality of the customer, if the customer is a good credit quality, the risk premium is low, which means they also pay lower interest. And if the customer has a bad credit quality, the risk premium is higher, which also means that they are going to be charged a higher interest. And you see this quite a lot when you now look at the type of interest rate that are charged by the bank as well. Remember, when you say you want a loan from the bank, how do they come about to say this is how much interest we're going to charge you? In simple terms, this is what they look at. Although it's a bit more complex here, but in simple terms, they have to take into account the risk premium. So which means the spread risk there is trying to take into account the extra risk that the bank is going to be taking when they give you the loans as well. Are we on the same page? Any questions? Then there is also concentration risk. Now, when you look at concentration risk, this is where they say overexposure to an individual borrower, group, or entity or segment. So which means when you talk about concentration risk, this is where you are overexposed, where you're giving too much credit to a few customers or even one customer as well. So if you're giving credit to a few customers or one customers, this is where we talk about concentration risk. So as a typical example, this is where we see that as a typical example, we can look at it from a perspective where we say, let's say, for example, we have bank A. We have bank A, and bank A, they are able to give out loans worth 100,000, right? And they decide, you know what? We have customer X. Customer X, we're going to give them 50,000. And customer Y, we're going to give them 50,000 in loans to make it a total of 100,000. So which means if customer X ends up defaulting, right, it means the default rate here is going to be equal to, you're losing 50,000 of the total loan of 100,000. And it means your default rate in this case is going to be 50%. Because you're concentrating giving credit to only a few customers. Now, let's look at, for example, your bank B. Now, for bank B, they decided that with bank B, they are going to give each customer 10,000. So there's customer 1, they give this customer 10,000, customer 2, 10,000, customer 3, 10,000. which makes it a total of what? 100,000. So of the 100,000 in loans, they give each customer 10,000, which means when you look at this now, if customer one ends up defaulting on their 10,000 loans, it means your default rate in this case is going to be 10,000 of the total loans worth 100,000 multiplied by 100, which means your default rate in this case is 10%. So do you see where the concept of concentration risk comes in? Where we're saying, if you are giving loans to a single customer or to a concentrated group of customers, your default rate is going to be higher if one or more of the customers ends up defaulting, compared to spreading, giving out to as many customers as possible, the same 100,000, breaking it down and giving it to as many customers as possible. Because if one customer defaults there, your default rate is going to be 10% compared to having a default rate of what? Of 50%. So this is where concentration risk comes in. Are we on the same page? Remember, we are all these concepts that they're introducing you here, we are going to look at them in more detail as we go and proceed with the chapters as well. Any questions? Then they also look at correlation risk. And when it comes to correlation risk, they say common risk factors between different borrowers, industries, or sectors, which may lead to simultaneous defaults. So common risk factors between different borrowers, industries, or sectors, which may lead to simultaneous defaults. And this is where correlation risk comes in. Now, when it comes to correlation risk, we need to acknowledge that the correlation coefficient varies between -1 and +1. So this is where the correlation coefficient basically varies between. And when the correlation coefficient is +1, we say the two securities or the two assets are perfectly positively correlated. And when the two assets are having a correlation coefficient of -1, we say the two assets are perfectly negatively correlated. And when the correlation coefficient is 0, we simply say there is no linear correlation. Now, what this means is when we say two assets are positive, so which means any correlation between 0 and 1, we just simply say they are positively correlated. And any correlation between 0 and -1, we just simply say they are negatively correlated. They are perfectly when they are either at -1 or at +1. Now, if the correlation coefficient is somewhere on this side, let's say, for example, we are analyzing two securities. Let's say we are analyzing two securities. Security M, which is performing something like this. So this is security M, where you are looking at its returns over time. And what we see, so this is the performance of the returns over time for security M. So when we say the securities are positively correlated, we are just simply saying, so when we say the securities are positively correlated, we are just simply saying, when you're now looking at performance of, remember we are looking at the performance of security M there, right? When we look at security M, we are saying that they are more or less moving in the same direction. Where in general, when security M is increasing is having an increase in returns, security N is also having an increase in returns. When security M is having a decrease in returns, security N is also having a decrease in returns. And when security M starts having an increase in returns as well, we're also expecting in general security N to have an increase in returns. And this is what we mean by positively correlated. So what does that mean as well? So do you see that in periods where M is not performing well, N also does not perform well, which also means, remember, during these periods when a company or when an investment is not performing well, what is the likely chance? There's a high chance that when the company is not doing well, there's a high chance that they might also end up defaulting on their obligation as well. So which means when M might end up defaulting, there's also a high chance that N might also end up defaulting as well. Now, when you now look at negative correlation, this is where we can look at two securities and we look at their returns over time. So when you look at these two securities, we can look at their returns over time. And if we are given security M, which is performing something like this, when they're negatively correlated, we are saying they're generally moving in opposite direction. Where when M is having an increase in returns, N is having a decrease in returns. And when M is having a decrease in returns, M is having an increase in returns. And generally moving in the opposite direction. So this is where we describe securities as having a negative correlation. So which means, what does that mean? It also means that we are saying when M is doing well, there's a high chance that N might end up defaulting on their obligations, right? But if they default on their obligations, you are not going to be overexposed because those losses might end up being being covered by the positive returns there. So which means your portfolio is not necessarily having a situation where you are losing too much, because you don't want to be ending up losing too much as well. So that's basically what they mean when they talk about negative correlation as well. So which means our aim when it comes to our portfolio is to have a portfolio with the correlation coefficient closer to -1 as much as possible, because the closer we are to -1, the more diversified our portfolio is. So the more our portfolio is closer to -1, the more diversified our portfolio is as well. So this is what they mean when they talk about correlation risk. So there's a high correlation risk when you're close to +1, and there's a very low correlation risk when you are closer to -1. Are we on the same page? Any questions? Anyone lost? So when it comes to our portfolio or our credit portfolio, our main aim is to ensure that the assets in our credit portfolio have a correlation coefficient closer to -1 as much as possible, because the closer we are to -1, the more diversified our portfolio would be as well. All right, moving on. They also look at factors affecting credit risk, where you look at the expected and unexpected losses arising out of adverse credit events are as follows. And here, we are going to look at these factors. So we are going to look at these factors, but I'm going to remember these factors. They talk about the exposure at risk, probability of default, loss given default, and default correlations as well, right? Now, when it comes to these factors, I'm going to introduce you to a section which is going to be covered in more details as we go through the curriculum as well. Because you see that when we look at this section, where we talk about exposure at risk, they are all looking at calculation of the expected loss. And we're going to look at this in detail. So all these factors, where we talk about the chapter 3, if you check in chapter 3 of Bandyopadhyay, which we're going to cover later on as well, it talks about probability of default, which is also mentioned here. And then it also talks about the loss given default, which is also mentioned here. So which means all these factors, they are factors that contribute towards what? Expected loss. Now the question becomes, so where does this expected loss comes in? So before I start explaining these concepts in detail, I need to show you and demonstrate to you exactly where these concepts are coming from. All right. Remember we said for a typical lender, like a bank, we said its assets, which are income generated, these are the assets is what the organization of the bank uses to generate a return, right? The assets can be financed through capital or they can be financed through debt financing. And the debt financing can be money coming from the depositors or money coming from other sources of what? Other sources of debt as well, right? Now, when it comes to the return, right? How do banks generate this particular return? They can generate this return through giving out loans or investing in security. But remember, we said when they pursue this activity, that there's a risk that they might suffer a loss. Now, the question becomes, so these losses, how do we categorize these different losses? So these losses, they can be categorized mainly as two types: expected losses or unexpected losses. So there's typically categorized as expected losses or unexpected losses. Now, how do we determine the expected losses? So the expected losses for the bank, to see exactly how much expected losses we need for the bank, or we can, we need to cater for the bank. The expected losses are given as your exposure at default, which they explain which is going to be explained in that section that we're covering now, multiplied by probability of default, multiplied by the loss given default, multiplied by the term to maturity. And this is how they determine the expected loss. And then remember we said for every default situation, two things are going to happen. We're going to lose some, we may recover some as well, which means from 100% of the money that we have lost there, 100% minus the recovery rate. So 100% minus the recovery rate will tell us exactly how much we're going to lose in case of default as well as a percentage. So 100% minus the recovery rate will tell us exactly how much the loss given default is going to be. So what we're going to do now is we are going to now look at in detail to say, so what of this expected loss, what is this component of expected exposure at default? What is this component of probability of default? And what is this component of loss given default? That's what we're going to be looking at. I see there's a question.
Hi, Ronas. No, you've already
Yeah.
answered. I wanted just clarity on the equation at hand, but now you explained it. It's the expected default, eh?
The expected losses. So your expected losses
Equal
is
to the
equal to exposure at default, which we're going to cover in the next section.
next
The
section.
probability of default, which we're going to discuss in the next section. The loss given default, which we're also going to be discussing in the next section. I'm just showing you why are we discussing these different definitions as well. It's coming from here.
Thank you.
Why are we interested in determining our expected losses? Remember, I said when it comes to the interest rate that you're going to charge, which is the nominal interest rate, when it comes to the nominal interest rate that you're going to charge, when it comes to the nominal rate that you're going to charge, remember we said the nominal rate is given as the real rate plus inflation premium plus risk premium. So your real rate, your nominal rate, which is the interest that's going to be charged, for example, to a customer, the interest that's going to be charged to the customer is given as your nominal rate. It's given as your real rate plus inflation premium plus risk premium. And remember, we said this is your risk-free rate. So in determining how much is the risk premium that we're going to be charging there, the risk premium is going to be dependent on how much is the expected loss we're expecting to cover. So depending on how much loss we are expecting to incur from this customer, this is how we determine how much interest we're going to be, how much extra rate we're going to be charging the customer. So it will depend on how much losses are we expecting to cover there. But now, remember we said losses as well, they are not always going to be based on expected losses, which I explained here. So they are not only going to be based on expected losses. Our losses can also emanate from what? Unexpected losses. So how do we now cater for these unexpected losses? So the question now becomes, how do we cater for these unexpected losses? And these unexpected losses are going to be catered for by making sure that we have enough capital to cater for these unexpected losses. So which means when you now look at the evolution of the Basel Accords, in simple terms, when you now look at the evolution of the Basel Accords are mostly there to ensure that the bank has enough capital available to cater for unexpected losses. So now do you see where everything basically falls into place when it comes to the issue of losses? So here, we are going to learn more, start learning, being introduced to the expected losses. And then later on in the chapters there, we are also going to be looking at how do we cater for unexpected losses by ensuring we have enough capital within the bank to cater for these unexpected loss. Are we together? Any questions? Anyone lost? So with that in mind, they say when it now comes to, so when it comes to catering for these expected losses, when it comes to catering for the expected losses, they give us, remember we said your expected losses are exposure at default multiplied by the probability of default, multiplied by the loss given default, multiplied by M. M is just saying how many years to maturity does the loan have? Does the loan have 1 year to maturity? Does the loan have 6 years to maturity? Or does the loan have half a year to maturity? That's basically your M. Then when it comes to your exposure at default, which is the first component of what? Expected loss. They say your exposure at default, here they say, in the event of default, how large will the expected outstanding obligations if the default takes place? The basis for exposure at default is the outstanding and external limit booked in the official process system. So your exposure at default has to be estimated on the transaction level from historical default information available in the bank. For term loan with full utilization, where there is no chance to further increase the loan exposure in excess of the set transaction limit, your exposure at default will be equal to your outstanding amount. However, for lending products facilities such as overdraft, revolving line of credit that are characterized by an external limit and an average of the utilization of the month or outstanding amount, your exposure at default will be given as the outstanding amount plus the utilization given default multiplied by the free limit. And in this case, where UGD is the usage or utilization given default or the credit conversion factor, a portion of the unutilized or free limit has been considered in exposure at default calculation is because it is expected that the counterparty close to default tends to increase its utilization while the bank will work against this by reducing the available limit. So when it comes to the exposure at default, in simple terms, because in exam, in assignments, the lecture doesn't really complicate this story. In simple terms, your exposure at default is, at the time of default, how much is the customer still owing the financial institution? That's basically your exposure at default. Then they also talk about the probability of default, and then they say the probability that the obligor or counterparty will default on its contractual obligations to repay its debt. It is generally estimated by reviewing the historical default record of loans in a pool with similar characteristics. For example, the rating grades, asset class, the industry, or even the region as well. Or from temporal movement of the gross non-performing assets from standard category of advances. And typically in the exam, unless they ask you to manipulate to get the probability of default, usually the probability of default is given to you. Then there's also the loss given default. And here they say the percentage of exposure the bank might lose in case the borrower defaults. Usually it is taken as the loss given default comprises the fraction of exposure at default which will not be recovered by the bank following default. It comprises the actual cost of loss along with the economic costs associated with the recovery process. So historical evidence shows the loss given default is lower for loans with higher value, more liquid, and senior collaterals as well. Then another driver there is your default correlations. And here they say default correlations measures the possibility of one borrower to default in its obligations and its effect on another borrower to default on its obligations as well. So this default depends. This default depends on dependence is due to common undiversifiable factor. So default events are not independent. Defaults may occur in clusters due to correlation across sectors, regions due to common systematic factors. So correlations of default adds to the credit risk when portfolio of loans and advances is in consideration vis-a-vis single loans or advances. So when many borrowers default together, correlation effects becomes more pronounced. Thus, the correlation among distributions needs to be considered carefully in the risk measurement and management of credit portfolios. So are there any questions so far when it comes to the components that contribute towards your expected loss? Any questions? On the next section, they also say the credit risk is generally measured as a risk on individual counterparty transaction or default risk and portfolio risk. So the credit risk of a bank's portfolio depends on both external and internal factors. The elements identified for credit risk are shown in chart 1.1, and here they give us the key drivers of credit risk. And here the same, when it comes to the key drivers of credit risk, it can be portfolio risk or it can be transaction risk. When it comes to portfolio risk, this is where it can come from what? Concentration risk or intrinsic sector specific risk. Then if it's transaction risk, this is where it can come from downgrade risk, recovery risk, or default risk as well. Are there any questions regarding these key drivers of credit risk? Moving on, can we take a 10 minutes break until 12:30? Can we take a 12 minutes break? Sorry, can we take a 10 minutes break until 12:30? Then at 12:30, we look at borrower level risk versus portfolio risk. So can we take a 10 minutes break until 12:30? All right, can we continue? We're now moving on to the next section of the chapter. So we're now moving on to the next section of the chapter. And on the next section looks at borrower level risk versus portfolio risk. And here they say, when making credit risk decisions during lending, there is always a risk that the borrower might default on its contractual obligations to repay principal and interest. So the risk factors that are unique to the borrower causing them to default are called borrower-specific default risk. A borrower-specific risk can be measured by using credit rating, for example, borrower-specific probability of default, and facility-specific loss given default, and tracking the borrower rating movements. Portfolio risk arises from the composition of or concentration of banks' exposures to many assets to various sectors. Systematic factors are the external risk factors that affect the fortunes of a proportion of the borrowers in the portfolio. So concentration risk results from having a number of borrowers in the portfolio whose fortunes are affected by a common factor. This common factor is also called correlation factor or default or asset correlation. So systematic factors correlate with the portfolio risk to changes in macroeconomic environment. For example, the gross domestic product growth rate, unemployment rate, fiscal deficit, is etc. So the credit risk modeling is being extended into evaluating portfolio risk, especially in the areas of commercial and industrial loans, management of asset allocations in the loan portfolio, and portfolio monitoring. So the portfolio risk is influenced by idiosyncratic borrower-specific risk and external systematic risk. So the internal borrower's specific risk can be managed by adopting proactive loan policy, good quality credit analysis, prudent loan monitoring, and sound credit culture. So the external risk factors can be managed by diversifying the portfolio, correlation analysis, setting norms for borrower and sector limits, in brackets, the value at risk based on regulatory limits, and through effective loan review mechanism and portfolio management. So this is basically how you distinguish the analysis between borrower-specific risk as well as portfolio risk as well. So is there any question regarding the distinction between the borrower-specific risk as well as portfolio risk as well? Any questions? On the next section, they look at the importance of management of credit risk in banks. And here they say, credit risk management is important for banks because of the following reasons. The first one is market realities. And here they say, under market realities, they give us the first point, which is structural increase in non-performing assets. And here they say, these result in massive write-downs and losses. So the increase in stressed assets badly hit the banks as provision and capital requirements go up sharply, which squeeze their profit level. So subprime loans in the housing sector were one of the most important causes of the US financial crisis of 2008. So recently, a sector-wide analysis by RBI in 2014 demonstrates the challenge of stressed assets in the Indian banking system intensified during 2013 and 2014 due to the rising incidence of loan defaults in infrastructure, retail, small-scale industries, and agriculture. So this has resulted in slowdown in the system level credit growth. Then another market reality is to do with high concentrations in loan portfolios. And yet they say overexposure to a borrower or related group of borrowers can pose risk to the earnings and capital positions of a bank in the form of unexpected losses. So higher loan concentration makes banks vulnerable during economic downturn due to incidents of clustered defaults. Then they also look at capital market growth, and then they say it produces a winner's case effect due to increased competition, as many companies have alternate channels to raise funds through either bonds or equity instruments. Then there's increasing competition, and there they say higher competition amongst banks to book big loans, leading to lower spreads and net interest margin. So this is a primary concern for top management in banks. Because remember, when you talk about increasing competition there, they're basically saying that because there's an increase in competition, it means that the bank is not going to be able to charge interest as high as they would want to. Remember, we said what contributes towards the nominal rate of interest is the risk rate of interest plus the risk premium. So to account for the risk premium there, it basically means that if there's going to be a lot of competition within a particular industry as well, it means that the interest that is going to be charged is not necessarily going to be as high. And because of this, it means that they are going to end up losing out on what? On potential profit margins as well. Then there's declining and volatile values of collateral. And then they say a decline or volatility in collateral value warrants greater amount of credit risk due to uncertainty in loan recovery. So both the East Asian crisis and the US subprime crisis have revealed that collateral value falls faster than the borrower's increasing chance of default as well. Then they talk about the growth of off-balance sheet credit products, and then they say a rapid growth of off-balance sheet products like various structured products, for example, collateralized debt obligations, credit derivatives, etc., to trade the credit risk positions has heightened the need for more prudent bank regulations because of the trading of these instruments, for which their value is not necessarily going to be reflected on the balance sheet, although they can also end up contributing towards what? The losses of the organization as well. So which means that an increase in these off-balance sheet products also increases what? The effects of market effects as well. So is there any question regarding the market effects? Another factor looks at changing regulatory environment. And yet they talk about the Basel II, where they talk about Pillar 1, 2, and 3 requirements, and then the Basel III, where they talk about the dynamic provisioning, stress testing, and counter-cyclical buffer. And yet they say the regulatory compliance enables a bank to establish a risk management framework, set appropriate control process, and improve corporate governance framework. So the regulatory compliance is involuntary in nature and enhances a lot of values for the organization as well. So which means changing in a regulatory environment also contributes as well. Then they also look at institutions' risk vision. And here they say capital is a scarce resource, need optimal utilization. So the success or return in a project of a financial institution is observed by its stakeholders, which can be the market competitors, the shareholders, or the debt holders. If the financial institution is engaging into a new business or expanding into existing business, it requires capital as a buffer against what? Unexpected risk of losses. Then you also look at improved improve risk-adjusted return on capital, which we're going to look at later on as well, and risk-based pricing. And yet they say a risk-adjusted performance measurement framework would guide to link its business growth targets, risk management process, and shareholder expectations. Then from here, we also look at the role of capital in banks. And here we're going to look at the difference between regulated capital and economic capital. And here they say, so when you talk about regulatory capital and economic capital, so when we talk about regulatory capital and economic capital, we are saying remember, we said that to cater for unexpected losses, according to we need to use the Basel Accords to cater for the unexpected losses, right? And based on the Basel Accords, we say, we're going to cover this later on as well. Your capital requirement, in simple terms, when you look at the Basel Accords, you're going to say your capital requirement is given as your capital adequacy multiplied by the value of your risk-weighted assets, in simple terms. So in simple terms, your capital requirement, remember we said to cater for the capital requirement there for the unexpected losses. The capital requirement, this capital requirement that is needed to cater for the unexpected losses, the capital requirement is given as your capital adequacy multiplied by the value of your risk-weighted assets. So which means, when in simple terms, we're saying the value of your assets multiplied by the capital adequacy. And here in South Africa, the capital adequacy is usually 10%. So which means, unless otherwise stated, you assume a capital adequacy of what? 10%. Because we're saying to see how much capital we need to absorb these losses from our assets. So to see how much capital we need to absorb these losses from our assets, especially the unexpected losses, we say 10% of the value of our assets which are exposed to risk. The value of our assets which are exposed to risk is the risk-weighted assets. So the value of 10% of our assets which are exposed to risk, in simple terms, this gives us the capital requirement. But now, how we determine this value of our assets which are exposed to risk? It goes back to the evolution of the Basel Accords to say, how do you find the value of these risk-weighted assets? So based on the evolution of the risk of the Basel Accords now, the Basel Accords will say the value of the risk-weighted assets, as you can see with the Basel Accords, the value of these risk-weighted assets is basically increasing by taking into account different risk factors, because for each of the different risk factors that are going to be taken into account when you look at the evolution of the Basel Accords, this affects the value of the risk-weighted assets as well, to see how much risk-weighted assets we need to cater for. Then 10% of those risk-weighted assets is what we're going to be putting in as the capital requirement. So this is where the evolution of the Basel Accords comes in. Now, when you look at the capital based on the Basel Accords, so when you look at the capital based on the Basel Accords, this capital that is based on the Basel Accords, this is your regulatory capital. So this capital that is based on the Basel Accords is what we refer to as regulatory capital. So the capital requirement based on the Basel Accords is what we refer to as the regulatory capital. Now, economic capital is where we're going to say as a financial institution, how much we don't want to have too much capital available within our business. Because if we have too much capital here, what does that mean? Having too much capital here within a business, we're saying that we're having to set aside too much capital within the business. It might end up what? Affecting our returns as a business. Because remember, your return as a business is what we refer to as your return on capital. So which means your return on equity, remember we said your equity is your capital there, right? So your capital in this case is also referred to as your equity. So your return on equity is given as your net income divided by the value of equity. So your return on your capital is given as your net income divided by the value of equity. So for banks to boost their return on equity, this one. Because remember, the return on equity, remember, we know that banks, they are there to generate a return for the investors. Remember, we say the goal of the firm is to maximize shareholders' wealth. To maximize shareholders' wealth, that's a long run goal. In the short run, to maximize shareholders' wealth, in the short run, we need to maximize what? Profitability, right? So how does the financial institution maximize profitability? You can measure profitability by measuring the return on equity. Now, how do we maximize this return on equity? We can maximize this return on equity by either increasing our net income as much as possible or by having a low amount of equity. Now, this is why if you check in the US, there's always going to be that friction between the government and the banks. The banks, they are trying to move towards deregulation. Why? Because they don't want to be limited, or they don't want to be limited on their activities by having too much equity. Because if they have too much equity there, their return on equity, which is their profitability, goes down. So what did the banks want to do? They want to reduce this rated requirement so that if they reduce the equity that is required there to cater for these unexpected losses, they are able to use that money, they're able to free that money and use that money to generate a higher return as well. So because of this, that's why you see that in the US, there's always that friction between regulation and deregulation. Why? Because the more regulated you are, the more capital you are required to set aside to cater for unexpected loss. So that capital, for regulatory purposes, we refer to it as regulatory capital. But now we are saying there is also what we call economic capital. Economic capital is the minimum amount of capital that we try to maintain here, so that if we maintain a very low amount of capital, we are able to increase our return on capital as well. So to improve the return on capital, it means as a bank, we need to have a lower amount of capital. So if we have a low amount of capital, it basically means that we are also running the risk that if there's going to be losses here, we might not have enough capital to absorb these losses. So there's always going to be a friction between regulatory capital and economic capital. Economic capital is the minimum amount of capital that you need to say, from an economic perspective, this is the minimum amount of capital that we need to set aside so that we're able to not to be bogged in by, because remember, if you are going to be maintaining a certain amount of capital there, it's just money that is basically just sitting in to absorb potential losses in the future. But we know that every business doesn't want to be sitting on money. They would rather be using that money to make more money, because if they're using that money to make more money, their return on equity is going to be improving, which means even the board and the top management, they're also going to be able to earn bonuses when they improve the profitability of the organization, which is the bank in this case. So are we on the same page now when it comes to the difference between economic capital and regulatory capital? Are there any questions between the two? So we can move on. The last section that we're going to look at today, we're going to be looking at the credit risk management framework. So we're going to be looking at the credit risk management framework. And under this, they say, in general, credit risk management for loans involves, so when it comes to credit risk management for loans, it involves a borrower selection, where selection of borrowers by using proper rating models and the delegation of rules that specify responsibility for taking informed credit decisions. Then it also involves limit setting. Set credit limits at various levels to avoid or control excessive risk taking. So most banks develop internal policy statements or guidelines setting out the criteria that must be met before they extend various kinds of loans. Sorry. Then the next one is portfolio diversification. Banks spread their business over different types of borrowers, sectors, and geographical regions in order to avoid excessive concentration of credit risk problems and conduct proactive loan portfolio monitoring. In order to monitor and restrict the magnitude of credit risk, prudential limits have been laid down in the loan policy. The portfolio quality is evaluated by tracking the migration of borrowers from one rating category to another under various industries, business segments. Then there's also risk-based pricing. And then they say the implementation of a more systematic pricing and adoption of the risk-adjusted return on capital framework enhances the organization value. A benchmark rate reflective of lending costs of the bank, which can be used with an appropriate markup, like a credit spread, to lend to various categories of borrowers. For example, a bank can formulate an interim risk pricing policy to price its borrower accounts based on the rating category. So a robust credit pricing model needs to generate a credit term structure consistent with empirical properties. So banks should be looking to formulate pricing models that reflect all of the costs and risks they undertake. So the pricing model should be realistic, intuitive, and usable by the business people. Then they also say credit risk management framework should enable the top management of banks to know which, when, and how much credit risk to accept to strengthen bottom line. So it constitutes the following steps. You need to identify the risks, that is data capturing and identifying the drivers from the various rating models. Then you also need to measure the risk by assessing in terms of size, timing, and probability for which the bank should have proper systems and tools in place. Then they also need to manage or control the risks, which is based on these measures. Various reports can be generated that would help the management in avoiding, mitigating, offsetting, and diversifying the credit risk in various portfolio segments. Then you also need to monitor the risk in order to categorize significant changes in risk profile or controls. Then they also say the sound practices of credit risk management specifically address the following areas: establishing an appropriate credit risk environment, operating under a sound credit granting process, maintaining an appropriate credit administration measurement and monitoring process, and ensuring adequate controls over the credit risk. And then lastly, they say the credit risk management process in a bank should aim at taking informed credit decisions, setting provisioning and reserve requirements against current or future levels of profitability in order to measure risk-adjusted performance, establish minimum pricing levels at which new credit exposures to an obligor may be undertaken, which is termed as base rate, pricing credit risk in instruments and facilities through estimation of credit spread, measuring the regulatory capital charge following standardized IRB or IRB approaches. We're going to look at those later on when we look at the evolution of the Basel Accords. Then measuring the actual risk capital or economic capital, and then calculating the risk-adjusted performance measures such as risk-adjusted return on capital, which we are also going to look at later on as well. So are there any questions on what we've covered so far from chapter 1 of Bandyopadhyay? Any questions? All right. So let's end here today. Please note, in the next class, we are still going to continue with study unit 1. Because remember, study unit 1, over and above looking at chapter 1 of Bandyopadhyay, we also need to look at chapter 2 of Whitney. We also need to look at chapter 2 of C.P. Joseph as part of what? Study unit 1. So in the next class, we are going to continue with study unit 1. And remember, the class on the 28th, it's still made available to everyone. Everyone in the public is able to attend those classes. And please note that anyone is able to attend those classes. We're making it available to everyone. And in the next class, we are going to be continuing with study unit 1 as well. If you are on the trial package, I would recommend that you create a user account on our website and then send to me your email address that you used when you create a user account, and also the modules that you want to be linked for the trial package as well, so that you are able to access this material that you're going to be needing for the classes as well. Because remember, without this material, you don't benefit much because you don't know exactly where are we going and where are we coming from when it comes to the material being covered here as well. Are there any questions? All right. If there are no questions, enjoy the rest of your weekend.